Ladies and gentlemen, thank you for joining what may turn into one of the most pivotal conversations of this year. The tide is turning. After months of volatility, capitulation, and relentless pessimism, the indicators I've been watching are finally converging toward a structural shift, one that markets have been too skeptical to price in. What we're witnessing isn't just a relief rally, it's the early tremor of a massive repricing, driven by innovation, disinflation, and a return of liquidity. The pain that dominated sentiment wasn't without purpose. It flushed excesses, recalibrated valuations, and reset the risk framework for the next exponential phase of growth. Now, the setup is stronger, cleaner, and vastly more asymmetric on the upside. The market's obsession with short-term pain blinded it to long-term transformation. Capital flowed into defensive assets, while innovation-centric equities were sold as if disruption had somehow paused. But innovation doesn't slow down during drawdowns, it compounds. Artificial intelligence, energy storage, robotics, and genomics are advancing faster than ever, and the productivity unlocks they represent are deflationary in nature. That's the key many investors have missed. The deflation we're seeing is not destructive, it's creative. It's the byproduct of exponential technologies scaling into every sector, compressing costs, expanding margins, and reshaping supply chains. For months, inflation narratives dominated the headlines. Every uptick in CPI became an alarm bell, every Fed comment a panic trigger. But inflation was never going to be permanent. It was cyclical, policy-driven, and exacerbated by transient supply shocks. The data now tells a clearer story. Real rates are stabilizing, the dollar is softening, and liquidity conditions are normalizing. That combination historically precedes multi-quarter equity expansions. More importantly, it re-enables risk capital to flow back into the sectors that drive future growth. The green candles ahead are not a speculative mirage. They are the rational outcome of a macro reset aligning with technological acceleration. What makes this next phase different is the foundation beneath it. The companies that survived the last cycle's volatility have been forced to become leaner, more efficient, and more disciplined. Many are now sitting on strong balance sheets, with real cash flow, scaling into markets that are expanding exponentially. The innovation platforms AI, blockchain, robotics, energy storage, and precision medicine are intersecting, feeding each other's growth loops. When these platforms converge, they don't just create incremental growth, they redefine cost structures and open trillion-dollar adjacencies. The last time markets underestimated such convergence, we saw an entire decade of value creation that reshaped global indices. This wave of green isn't about momentum, it's about conviction. It's about recognizing that markets move in cycles of fear and discovery, and we've just exited one of the most fear-driven phases in modern history. When pessimism becomes consensus, when positioning is defensively skewed, and when valuation spreads reach generational extremes, that's where asymmetric opportunity lives. Right now, that opportunity sits in the same innovation sectors that were deemed too early or too risky only months ago. The irony is that by the time the majority accepts this shift, the easy gains will already be realized by those who acted on conviction rather than comfort. Capital markets are emotional ecosystems. They oscillate between denial and euphoria, but the long-term trajectory is determined by productivity and innovation. Every historical cycle has proven this pattern. We saw it after the dot-com crash, after the financial crisis, after the pandemic corrections. Each period of pain became the foundation for exponential upside once the structural shifts were recognized. This time will be no different. In fact, the coming expansion could be even more powerful because the catalysts are broader, the technologies are more interconnected, and the barriers to scale are collapsing faster than ever. What matters now is perspective. While algorithms chase short-term volatility, vision-driven investors are positioning for the next 5 years, not the next 5 days. The alignment of falling inflation, technological deflation, and re-accelerating innovation spending is rare, And when it happens, markets don't just recover, they reprice the future. The green candles forming on the horizon are a signal, not noise. They're pointing to a market that's rediscovering optimism, re-embracing innovation, and ready to capitalize on the exponential growth curve ahead. The pain was necessary. It cleared the path. Now comes the wave. And when it hits, those prepared will see not just recovery, but transformation. Every cycle delivers moments of deep mispricing, windows where fear overwhelms fundamentals, and innovation gets thrown out with speculation. That's exactly where we are right now. While most investors remain trapped in a defensive mindset, paralyzed by short-term volatility, a new set of opportunities has quietly emerged. These are not the mega-cap names dominating headlines, but smaller, underappreciated companies, truly dirt cheap in valuation, positioned at the heart of exponential innovation platforms. The market has discounted them as if their growth potential has vanished, but the data tells a radically different story. These three companies are standing at the inflection point of technological and economic disruption, and when revaluation hits, it won't be gradual, it will be explosive. The first sits squarely in the AI infrastructure layer, but not in the obvious places everyone's chasing. It's the company building the plumbing for artificial intelligence, the hardware acceleration, the low-power architecture, the unseen efficiency backbone that allows large-scale neural networks to function outside centralized data centers. The world is moving rapidly toward edge computing and on-device intelligence. As AI models shrink and efficiency improves, inference shifts from the cloud to the edge, to devices, vehicles, factories, and homes. This company enables that transition. Its technology reduces latency, cuts energy consumption, and decentralizes intelligence. Yet it trades as if AI demand will plateau. That disconnect between market perception and technological inevitability is extraordinary. Once profitability scales, and it will, the re-rating could be violent and sudden. The second is a renewable energy disruptor, deeply embedded in the transition toward decentralized, intelligent energy networks. For years, markets treated clean energy as a slow-moving policy narrative, but now the economics have caught up. The cost curves for energy storage, solar efficiency, and grid automation are collapsing exponentially. This company operates in the integration layer, software and analytics that connect distributed energy resources from rooftop solar to electric vehicles into a self-balancing, AI-driven network. It's the digital layer of the new power grid. What's fascinating is how misunderstood it remains. Investors see an energy software company, but in reality, it's becoming the operating system for the clean energy transition. The margins, scalability, and network effects are far more aligned with technology multiples than industrial ones. As capital reallocates from legacy utilities to high-efficiency digital energy infrastructure, this name could experience a step change in valuation. The third company represents the next generation of genomics and precision medicine. For years, biotech has been cyclical, and genomic sequencing was seen as too early, too expensive, too speculative. But the cost of sequencing a genome has dropped from billions to hundreds of dollars, and we're now entering a phase where population-scale genomics meets machine learning. This company is pioneering AI-driven diagnostics, analyzing genetic data at scale to predict disease before symptoms appear. The total addressable market is enormous. It's not about curing disease after it strikes, it's about preventing it entirely. And yet, the stock trades at a fraction of its intrinsic value, largely because macro uncertainty has driven capital away from long-horizon biotech. As regulatory clarity improves and partnerships expand, this company is set to become one of the most consequential players in the health tech revolution. What ties these three companies together isn't just undervaluation, it's inevitability. Each is building infrastructure for an exponential trend, AI at the edge, digital energy networks, and genomic intelligence. These are not cyclical opportunities. They are structural, transformative, and compounding. And yet, because markets remain fixated on macro noise, they're trading at discounts we rarely see in innovation cycles. Historically, these disconnects precede periods of massive multiple expansion. The narrative shifts from too early to too late in a matter of months. We've seen this before in every innovation wave, whether it was the internet, mobile computing, or electric vehicles. The most asymmetric returns came from companies dismissed by consensus. When the market catches up, it doesn't do so linearly, it re-rates exponentially. That's what's about to happen here. These aren't speculative moonshots. They're the foundation stones of the next decade of industrial and digital transformation. The repricing will be swift, and it will reward conviction over comfort. Investors who can see through the fog of fear, who understand how exponential curves unfold, will recognize this as one of those rare inflection points where technology, timing, and valuation align perfectly. The window won't stay open for long, but for those ready to act, the upside potential could define the next generation of market leadership. What we witnessed today wasn't just a milestone for one company or one entrepreneur. It was a validation of an entire vision for the future. For years, skeptics dismissed the convergence of artificial intelligence, robotics, and sustainable energy as an overreach, a futuristic dream too far ahead of its time. Yet, today's developments have made one thing abundantly clear: that future has arrived faster than anyone anticipated. The magnitude of what just unfolded goes far beyond market capitalization or quarterly metrics. It speaks to a fundamental re-architecting of how we produce energy, transport ourselves, and interface with technology. The scale of this day marks a generational turning point, both for innovation and for the mindset of global markets. The story here isn't just about a company delivering on its promises. It's about an ecosystem that's beginning to compound at a rate traditional finance has consistently underestimated. For decades, analysts evaluated innovation on a linear scale, assuming progress moves in predictable, incremental steps. But exponential technologies defy that logic. What we're seeing in real time is the culmination of several exponential curves: electric vehicles, autonomous driving, AI integration, and energy storage intersecting simultaneously. The synergy between them is the real breakthrough. Each advance in one domain accelerates the others, creating a positive feedback loop that traditional valuation models cannot capture. Markets are now beginning to realize that this isn't just a car company or an energy producer, it's a technology platform. The data being generated across millions of connected vehicles, energy grids, and robotics systems forms a neural network of physical intelligence. That network learns, adapts, and scales with every interaction. It's a business model that compounds with usage, similar to how software networks grew in the digital era, but now it's applied to the physical world. When the physical and digital realms merge, productivity explodes. That's what makes today so monumental. It demonstrates that the infrastructure for this new age of convergence is already functional and accelerating. For investors, the significance of this moment cannot be overstated. We're witnessing the kind of structural shift that redefines entire sectors. Energy, transportation, manufacturing, and artificial intelligence are no longer isolated silos. They're components of one interconnected system. This convergence drives down costs, enhances performance, and accelerates adoption curves. The implication is simple: companies that harness these convergences don't just grow, they redefine economic baselines. And those who continue to value them through the lens of legacy industries will consistently underestimate their potential. Critics often point to volatility as evidence of fragility, but in innovation-driven markets, volatility is the natural byproduct of paradigm shifts. Each pullback, each bout of skepticism, acts as a stress test, refining conviction. exposing weak hands and redistributing capital toward visionaries. Today's gigantic day underscores that principle. It's a reminder that disruption always feels uncomfortable until it becomes undeniable. The market may still oscillate between disbelief and euphoria, but the long-term trajectory is set. The technological foundations built today are not cyclical. They're compounding at a pace that will reshape global GDP growth over the next decade. What stands out most is how leadership rooted in vision can mobilize innovation at scale. This wasn't achieved through incremental optimization. It was driven by conviction in first principles, by rethinking physics, economics, and human behavior from the ground up. Barriers that once looked insurmountable have been systematically dismantled. The ripple effects extend far beyond one company. They're influencing entire industries to accelerate their innovation roadmaps. From energy storage breakthroughs to full autonomy, each step forward acts as a catalyst for broader systemic transformation. Today's events should remind investors that disruptive innovation doesn't move in straight lines. It moves in leaps, sometimes quiet, sometimes seismic, but always toward greater efficiency and intelligence. What we've seen is a glimpse of what's coming, a world where transportation is autonomous, energy is renewable, and artificial intelligence operates seamlessly across the physical economy. This isn't a speculative dream, it's an unfolding reality, one that's scaling faster than the market can price in. For those willing to think exponentially rather than linearly, this day wasn't just a win for one visionary. It was confirmation that the era of intelligent, interconnected innovation has truly begun. Volatility always tests conviction, but every disruptive technology experiences moments when fear overshadows fundamentals. What's unfolding in crypto right now is no different. The volatility, the fear, the regulatory noise, all of it, is part of a necessary cleansing cycle that resets the stage for exponential growth. When we look ahead to 2026, the data, the structural changes, and the capital flows all point toward a phase of massive maturation and institutional integration. The underlying technology, blockchain, is not retreating. It's scaling, evolving, and embedding itself deeper into global financial infrastructure. The short-term panic that grips markets today will likely be remembered as the last shakeout before the next wave of adoption begins in earnest. The most misunderstood element of this cycle is that crypto is not just about speculative assets, it's about architecture. Bitcoin and other decentralized networks are building the next layer of the internet, where value moves as seamlessly as information. Over the past year, we've seen developers, institutions, and governments quietly preparing for this shift. Layer 2 scaling solutions, cross-chain interoperability, and real-world asset tokenization are becoming operational realities. These are not theoretical white papers anymore. They're working systems processing billions in transactions. And when monetary systems evolve this quickly beneath the surface, the next leg of growth often arrives faster than consensus expects. By 2026, I believe we'll see Bitcoin transition from being viewed as a speculative risk asset to being recognized as a global reserve alternative, a hedge not just against inflation, but against monetary instability itself. As global debt levels continue to climb and sovereign currencies become increasingly politicized, investors and even central banks will seek assets that are neutral, verifiable, and immune to manipulation. Bitcoin embodies that neutrality. Its scarcity, transparency, and decentralized security model are precisely what make it uniquely suited for a world where trust in traditional systems is eroding. The early adoption phase is ending. The infrastructure phase is accelerating. At the same time, the innovation ecosystem surrounding crypto is expanding beyond Bitcoin. Decentralized finance DeFi, once experimental, is now attracting institutional liquidity. Tokenization of equities, bonds, and commodities is blurring the line between traditional and digital markets. Smart contract networks are integrating with payment systems and supply chains, creating programmable financial logic that reduces friction and cost. What's happening beneath the price volatility is an efficiency revolution, one that will compress decades of financial evolution into just a few years. 2026 could be the year when blockchain-based settlement becomes the default infrastructure for global transactions. The key catalyst for this transformation is institutional adoption. Over the next 18 months, we'll likely see large asset managers, sovereign funds, and fintech platforms expanding their digital asset exposure. This isn't speculative behavior, it's strategic positioning. Bitcoin ETF have opened the door for compliance, friendly exposure, and regulatory frameworks are gradually catching up to technological reality. As clarity improves, so will confidence, and with confidence comes capital. That's when volatility subsides and the asset class begins to behave more like a macro anchor than a trading vehicle. The irony is that the very institutions that once dismissed crypto are now laying the groundwork for its normalization. For individual investors, this is a moment to shift perspective, from short-term noise to long-term architecture. Every major innovation cycle goes through the same emotional phases: disbelief, euphoria, fear, and then realization. Crypto is currently transitioning from fear to realization. The fear is temporary because the fundamentals are strengthening. Hash rates are hitting all-time highs, on-chain activity remains robust, and network development continues to grow. The ecosystem is healthier than the headlines suggest. What we're witnessing is a repricing of risk, not the collapse of innovation. Looking toward 2026, the convergence of blockchain with artificial intelligence, Internet of Things, and digital identity will redefine how economies function. These technologies will not remain isolated. They will merge into a self-free, enforcing loop that enhances transparency, efficiency, and decentralization. The world's financial architecture will increasingly run on open protocols, not closed intermediaries. Bitcoin and crypto are the foundation of that system. The next phase will not just be about speculative upside, it will be about structural integration, and those positioned early will benefit disproportionately. So when the market panics, it's crucial to remember the bigger picture. Innovation doesn't pause for sentiment. The crypto market is not dying, it's evolving. The noise will fade, but the signal will remain. 2026 won't be the end of the crypto story. It will be the moment the rest of the financial world finally realizes it's been rewritten.